More money making. Today I want to talk about one of my favourite ways to invest, which is in my opinion the best and safest long-term investment strategy out there for most people. It requires very little work and no real skill and will outperform most individual investors, both amateur and professional. What I'm talking about is index funds. So let's go over what an index fund is, the different types, and the advantages they have over investing in individual stocks. As always, if you like what you're watching, please destroy the like and subscribe buttons and notification bell for the YouTube algorithm. An index fund buys all, or a representative sample of, the securities that make up that index. For example, if the index tracks the S&P 500, which is a market capitalization weighted index of 500 of the largest publicly traded companies in the US, then the fund buys shares from every company listed in the index in different amounts according to market cap. In this case, for example, as of 2021, the fund would hold more Apple stocks than that of JP Morgan. An investor buys shares from the funds, which buys them a small portion of all the companies in the index. The alternative is to buy shares in each company or a subset of them individually. Note that when I discuss index funds here, I'm primarily talking about what's called passive funds. Passive funds aim to deliver the market return by investing in a representative sample of it. I'll discuss active funds a little later. The first advantage of investing in an index fund is that you're spreading the risk by what we call diversification. So if one of these companies does badly, it's likely that others will do well and you'll get a positive return overall. Investments in general can be volatile in any given year, but give good returns in the medium to long term. Conversely, if you invest all your money into one of these companies, then you run the risk of having made a bad pick and that company doing badly or even going bust. For example, if you'd invested all your money or a large portion of your wealth into Enron, Toys R Us or Blockbuster and so on, you would have taken a significant hit, never to be recovered when they went bankrupt. The second advantage of index funds is they have very low fees because they're simple to put together and manage. There isn't much overhead as the fund gets automatically rebalanced and adjusted over time without the investor doing any work themselves. Conversely, it's very time-consuming and often costly to buy and sell individual stocks, which involves several different transactions where you usually get charged a fee for every one. And without rebalancing, you could end up owning more of a particular stock than you would like, which means even more trades are needed. Even free stock trading apps like eToro will make their money from spreads, which is the difference between buy and sell price, withdrawal fees, currency conversion fees, and inactivity fees. Another option is to use what's known as an actively managed fund, where the managers have to decide what to buy and sell, rather than just buying a representative sample of the index. These are more costly than passive funds, since you're paying these managers to do this. The average expense ratio for actively managed funds is between 0.5% and 1%, and it can reach up to 2.5% or more. For passive index funds, the typical ratio is about 0.2%. Because of these higher fees, an active fund needs to achieve greater returns than a passive fund to be cost efficient. Another advantage of passive funds over active funds is that only a tiny percentage of active portfolio managers, around 10% or less, actually outperform the market index over a 15-year period. So you're paying higher fees for worse performance in most cases. Being able to predict which of these fund managers will outperform the market index in advance is nigh on impossible. For example, Neil Woodford was an investment manager widely credited with star status following a successful career in the city, and he opened the Woodford Equity Income Fund in 2014. The initial performance was good, but fast forward 5 years and his funds are in wind down, he is removed as manager and his reputation is in ruins. And this is a professional investor. The performance of individual investors picking their own stocks is even worse. The third advantage of index funds is it reduces the human emotion factor from investing. Most people can't handle the market volatility and will tend to sell when the market is falling but then by the time they buy back in, they've missed out on most of the gains, meaning they would have been better off just staying invested. Historically, some of the biggest days of gains have followed the biggest days of losses. Investing in an index fund, compared to individual stocks, is likely to produce less severe losses on the way down, meaning you're less likely to panic sell when the market is low. Also, with an index fund, you're likely to have set up some kind of automation, such as a standing order for regular investment, which makes it easier to continue buying in even when the markets are falling. It can be hard psychologically to manually initiate buy orders in such circumstances. The fourth advantage of index funds is it's very quick and easy to simply invest your money into an index fund and know that you then own a small part of a broad set of companies. The alternative is having to spend a lot of time researching an individual company by looking at company reports and financials and evaluating whether the current price is fair, whether dividends will be paid, and the company's future prospects. And if you want to achieve any level of diversification, you need to be invested in a number of individual companies, which means the research time is multiplied many times. The fifth advantage of index funds is not only does it take a lot of initial research, it also requires a lot of ongoing research to decide if the investment is still a good one that you should hold on to or invest more into, or whether the company is now overvalued and the time has come to sell. Additionally, you need to compare each company you're invested in against one another to decide if you have the desired proportion of each one. The sixth advantage of index funds is that you're not competing against the pros. These are people that do this for a living, performing technical analysis on real-time data and using computer algorithms to execute trades. Trying to do all this manually alongside your regular day job is very time-consuming, stressful, and comes with no guarantees you'll even gain greater returns. Instead, investing in index funds means you're just accepting the market return, which over the last century is around 10% per year on average. The broadest passive index funds available are global multi-asset funds. An example is Vanguard Life Strategy 80, which holds a global portfolio of stocks and bonds. An alternative is to invest in various different index funds that track the index of an individual asset like stocks, an individual country like the UK, or an individual industry like technology. But bear in mind that the more different funds you add, the more complexity you add in terms of research, rebalancing, and added costs as you move more towards the realm of picking individual stocks in your desired proportions. See my videos on asset classes for a discussion of the different things you can invest in. Thank you so much for watching. I really appreciate it. Please add your own thoughts and follow-up questions in the comments, and I'll try to get through as many as I can. If you made it to the very end, please destroy the like and subscribe buttons and notification bell so you never miss a chance for more money making.